Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This video is about financial advice, which is a very broad topic. I'll try to keep it reasonably short and practical for you to know whether you want to have a financial advisor, and if you do, how to choose one or know whether to get a different one if you have one right now. Let me preface the video by saying that most people are completely capable of running their own simple, basic ETF or index portfolio themselves. A large number of people, however, feel a lot better if there's a seemingly knowledgeable person who makes these decisions for them. The customer never finds out that in a good number of cases, the financial advisor underperforms those basic ETFs or index funds. The need for the financial advisor has been fostered by the financial services industry since it's in their best interest, making investing seem like a dark art whether only the advisor can help you, because it's so complicated. It's not. You can do it yourself. But if you really don't want to, have other priorities, don't want to educate yourself about something that bores you, and like the feeling of walking into a bank or a lovely office and speaking to a self-assured advisor, let's carry on. We'll talk about how financial advisor gets paid and how they add value to you and other topics. I'll mention robo-advisors at the end, but otherwise this video is about human financial advisors sitting behind a big desk in a suit, making you comfortable about giving them your hard-earned money even though they don't know what the market will do tomorrow or the next month any better than you. The human can add value in a lot of ways, however. Let's talk about how financial advisors are paid, since compensation drives a lot of decisions people make. In this video and in your dealings with financial advisors, be on the lookout for a conflict of interest the advisor has, where their advice may be influenced by their compensation to not be in your favor. Canada has recently put legislation and directions in place where the advisor compensation needs to be disclosed on statements, which is a step in the right direction. Let's cover the most basic and common compensation schemes. The first is being paid by commission from the sale of mutual funds. The financial advisor could get up to 5% from the mutual fund company at the time of sale on a deferred sales charge load, or charge you 2 to 5% for a front end load. And then there is a quarter percent to 1% annual trailing fee while your money is invested. These fees come out of your pocket by paying the mutual fund management expense ratio, or MER. This is the most common version of compensation, and the advisor will tell you that you don't pay them. You're thinking, great, free advice. But the mutual fund company pays them, or their bank. So logically, since you are the source of income and not their best friend, they will choose investments that maximize their earnings, as long as the performance of the investments is good enough so you don't take your money elsewhere. Sorry, I didn't mean to sound cynical. Not all financial advisors are like that. The second way financial advisors are paid is by the transaction, which can lead to something called churning, where advisors perform transactions that are pointless and often not in your best interest. In this compensation format, you pay directly and you get a bill for each transaction. My mother had an advisor like this, and he sold one Canadian bank to invest into another Canadian bank. And he said that the new bank was better. Um, the sale and the purchase each cost my mother $800, however. Those who ever looked at Canadian banks can't really see a significant difference between them, however. The third way financial advisors gets compensated is as a percentage of assets, where the advisor takes a percentage fee depending on how much money you have with them. This sort of aligns their interest with yours, but the percentage can be as high as 2% if you have a small amount of money with them, which makes it tough to grow your money. The fourth and last major way that the financial advisor gets compensated is fee only, meaning they get paid by the hour. The advisor charges you hourly, and this is probably the only advisor that has no conflict of interest and will tell you the truth. For them to review your portfolio, however, depending on the number of investments and complexity, and to do a financial plan might be $2,000 to $5,000. This is fine if you have a $2 million portfolio, and I keep meaning to get one of these advisors to do a review for me, but it's impractical and very expensive if you have a $100,000 portfolio. If you are just starting out, either going on your own, having a financial advisor, or a robo-advisor is the way to go. You should understand which scheme your advisor is using and choose an advisor with the lowest fees according to what you want to do and currently own. Changing advisors, by the way, is fairly easy, so you can move from the one who is suddenly charging a lot of fees because your portfolio grew to another advisor who will charge you less since they are using a different compensation scheme. Just do the math to figure out which one you want. Now, don't be shy about asking how they get paid, since it all comes out of your pocket no matter what scheme is used. Be willing to pay for great advice, however, because it will pay for itself many times over in the long run. To give the opposite side of the argument, no one wants to work for free. We all need to put food on the table, and we all want to be paid for good work. So choosing a good financial advisor that adds value is important, and he or she is worth paying for. So now let's compare two types of financial advisors, bank financial advisors and independent financial advisors. So a bank financial advisor is paid a salary by the bank and has 400 to 600 clients. So personal attention, unless you have significant amount of money invested with the bank, is unlikely. They'll talk to you once a year. At the start, they will give you a KYC, a Know Your Client, which is 20 or so questions intended to learn your risk profile, how volatile your investments can be, what returns you need, and when you need your money back. And they will give you a preset portfolio of the bank's mutual funds, depending on your answers. If you go to RBC, you're most likely to get RBC mutual funds, good or bad. The portfolio selected is not specific to you, trust me, because that is way too much work. If you think they took your KYC into the back room, read some tea leaves, threw some bones, and sacrificed a lamb to get you the perfect portfolio, you are wrong. On the plus side, you can start investing with as little as $100. Now, I had an experience where I wanted to invest a small amount of money with a bank that shall remain nameless, and I showed up on a Saturday. The person who was on duty had just been licensed and knew nothing about nothing, being the quote unquote lowest man on the totem pole to be working the weekend. It was a painful experience since she didn't know even how to use the bank software very well. Make sure you don't get an advisor like that and don't pay for one like that. More on that later. Bank advisors are usually paid salary by the bank with some bonuses based on their sales. And yes, they are largely salespeople, with the financial advice being a byproduct. They may have a sales quota set by their bank. And if they tell you that you are not paying them, that is mostly a lie, because you definitely are. Independent financial advisors will also give you a KYC or talk to you at length to get to know you, and are also likely to have a preset portfolio that they have researched and are familiar with. It's likely they will choose the best performing mutual funds out of the funds that pay them the most commission, depending on how they get paid. They are not limited to one or two mutual fund companies, however, unlike the financial advisor at the bank. Two examples of independent financial advisors are those working at Raymond James or Edward Jones. These companies are sort of umbrella companies who provide research, marketing, and administrative services for those independent advisors in exchange for a monthly fee. The financial advisor could just own their own business entirely. They'll give you more personal attention since they probably have 100 to 200 clients, but will likely want you to have at least $500,000 or more invested with them. Now, I met a financial advisor who wanted to have 100 clients who each had $1 million with them, and he would service those clients very well. Now, I'm sure he wouldn't say no to the 101st client, though. He was charging 1% of the assets as a fee, so he was making $1 million per year himself if he had 100 clients, each with $1 million. Independent financial advisors are self-employed and are extremely likely to be more experienced and better than most of the bank advisors. They probably started out at a bank and after several years of experience went out on their own. They work entirely on commission, whatever form that may take. Let's talk about fiduciary versus suitability standards for financial advisors. This was a big conversation in the US a few years back, but sort of died down, and it was never a thing in Canada, I don't think. So, fiduciary standard for financial advisor simply means the advisor has to act in your best interest. This would mean the best performing funds, likely with the lowest fees, would be purchased. The by the hour compensation scheme I mentioned earlier, and possibly the percentage of assets, is the way these advisors are likely to be paid. The suitability standard just means the recommended investments are suitable to you according to your KYC risk profile. They don't have to be the best performing investments. The advisors working on commission are definitely in this category, and while they want you to succeed so you don't leave them, they could be selling you what is paying them the most commission. Now, of course, I've heard horror stories of advisors having retired people borrowing against their house to buy emerging market mutual funds so the advisor can make a hefty commission. But that is in neither the suitability nor fiduciary standard and is criminal. So, what should a financial advisor do for you? Well, financial advisors have to add value by doing and updating financial plans, which I'll talk about later. They should rebalance and update your portfolio, and please see a recent video about rebalancing. They should be teaching you, they should be checking on insurance, they should be asking you whether you have a will and a power of attorney, and they should be checking in on your mortgage. The highest value added by a financial advisor is that he or she talks you out of selling when the market is down. They educate you and they recommend investments that perform well within your risk profile. Let me list out some things that great financial advisors do. They don't just pick mutual funds, since I can do the same thing using ETFs and online research. They get all of my life together and show me blind spots and problems. He or she knows my life and points me to what is important for me out of the huge amount of web info that is available. They tell me to do nothing with my investments during market crashes, or they tell me to buy more, actually. They make me comfortable and not panic. They make me stick to the plan. They do a risk management for me. They help me with my budget so I have money to invest. They ensure I am saving into the right account types following a tax strategy. They know how I will be taking the money out later. They know the tax laws. They point out opportunities. They point out weaknesses. They look at the big picture for me because I may have lost it. And they talk to other experts on my team. So, for example, an accountant or a lawyer. So, some other things to keep in mind. No one will ever take as good a care of your money as you, period. So if you use a financial advisor, make sure to check up on them, educate yourself a bit, and be able to ask the right questions at the quarterly or annual meetings. Your financial advisor should definitely be licensed, but generally the standard for financial advisors these days is a CFP, or Certified Financial Planner. Other common designations in Canada are Registered Financial Planner, Personal Finance Planner, Chartered Financial Analyst, and Chartered Investment Manager. Make sure your advisor is one of these. Also, go to the IIROC website and find your advisor to see if there are any disciplinary actions or other faux pas. Googling them will also go a long way. Another thing when you are thinking about your financial advisor's performance is that you should compare investment performance to its benchmark or appropriate index, not just whether you made or lost money. A lot of people look at their portfolio performance in absolute terms. Did I make or lose money that year? But losses in the markets are normal and a part of the experience, and you can't blame your financial advisor for that. So if your portfolio went up 15% and the appropriate benchmarks were up 20%, your advisor is doing a poor job. But if you lost 5% but the market lost 6%, your advisor is actually doing well. As an aside, if you're running your own portfolio, compare its performance to the benchmark periodically. For example, Canadian stocks have the TSX as a benchmark. This way you'll see if you are beating your benchmark. If not, you may consider just running index ETFs since you'd get a better return. Let's talk about the financial plan the advisor does for you. A financial plan is an assessment of whether you'll be able to reach your goal. It may make certain assumptions and it will have a look forward in time to see whether you get to retire at a certain age, whether you'll have this amount of money that you're looking for, whether you'll have enough for a down payment for a house, etc., whatever it is that you are targeting. So the financial plans come in two flavors. In the financial plan, the financial advisor can either use a spreadsheet or they can do something called Monte Carlo simulations to see how your portfolio will perform and to tell you whether you need to save and invest more. If the financial plan uses a spreadsheet or simple software, the calculations use certain assumptions such as return rate, inflation, etc., and come up with one number just by doing the math. Your expected return is put in as an average, such as 7% per year. The advisor can fiddle with the variables and assumptions, but only one number and one graph is produced. This one is mine. Your plan then looks like this, getting the results based on your savings, spending, return, inflation, and time on this earth. If the financial plan uses Monte Carlo simulations, it's a nicer representation of the real world, where it takes that average 7% return and runs the simulation 1,000 times, which computers are great at, where the returns vary from year to year. For example, you could have a 12% return one year and a negative 3% the next year, all averaging to 7%. The added value here is that there's a timing risk to the market, where if you have some bad returns at the start of your retirement, for example, your portfolio never recovers if you have to pull money out of a portfolio that's just been dropped. The simulation will give you a result such as that you're 98% likely not to run out of money if you live for another 30 years. The screenshot is from Vanguard Simulator. All these calculators are available on the web for free, by the way. Just Googling financial planning and Monte Carlo simulations will be enough to find one that you like. As a final point about the financial plans, they should be reviewed once every couple of years and updated, and definitely checked if there's a life change, such as marriage, divorce, job change, new child, etc. A financial advisor should be chosen and interviewed so you know you are a good fit together, since this is ideally a long-term relationship. I have some sample interview questions for financial advisors, but I'm sure you can add others. Interview question number 1. What do you love about your job? Do you want to work with somebody who dreads going to work every day? Of course not. You want a financial advisor who loves what they do, someone with a sincere desire to help people. Be confident about your retirement. Not only will this question help you get to know your investing pro, but it should also clearly reveal their why. Do they care about the whole financial picture? Paying off debt, having an emergency savings fund, making sure tax bases are covered, and building wealth for the long term? What's their story of how they got into the business? You'll see what a financial advisor is all about by their response to this question. You'll also know very quickly if they're just punching a clock. Question number 2. What services do you provide clients? Now, a financial advisor can help you create a long-term investing strategy, weigh the pros and cons of different account types, pick mutual funds, rebalance your investing portfolio, and set savings benchmark to help you reach your long-term goals. They'll be able to answer your tough questions about investing so you can feel confident making decisions. Remember, it's important that your advisor understands your whole financial picture. Look for someone who not only understands your investing goals, but also your tax situation, your insurance coverage, and your real estate plans. A financial advisor can help you with more than just explaining complicated investing terms and helping you choose funds. They're often able to provide debt management or estate planning services as well. Financial advisors also have access to great online resources that can help you stay engaged outside of your regular meetings with them. Those resources can help you track your investment account performance, visualize savings milestones, or estimate the nest egg you need for retirement. When you meet with a pro for the first time, make sure you find out exactly what services and resources they offer to help you reach your financial goals. Interview question number 3. What is your investment philosophy? You've got to make sure you and your financial advisor are on the same page. That means they should have a long-term investing strategy. You want an advisor who will encourage you to invest consistently, no matter how the market is performing. A great financial advisor will want to learn about you, your overall financial situation, and your concerns, goals, and dreams before they start recommending strategies or products. But once they do start suggesting different approaches, you can expect a great advisor to recommend a variety of mutual funds with a history of above average performance. Question number 4. How will we communicate about my investments? You don't want to work with a financial advisor who only engages with you when you reach out. Look for someone who proactively communicates with you, keeping you updated on how your investments are performing and when it's time to rebalance your portfolio. How much should you communicate with your financial advisor? This will vary from person to person and depend on your own preferences, but you want to strike a balance that feels comfortable to you. For most people, that means connecting with their advisor once a quarter, with more of a formal check-in at least once a year. Some banks have a rule that if you have over $250,000 with them, you should meet quarterly. When you decide to hire a financial advisor, that's the time to speak up about how often you want to touch base. And make sure you communicate well with your advisor, whether by email, phone, or in person. If you can't understand what they are saying because of jargon, it's a bad sign. They should be trying to teach you about investing, at least a little bit. Interview question number 5. How do you get paid? When you meet with a pro for the first time, this may be one of your top questions. Paying an advisor for their service affects your bottom line, so it's important to have a thorough understanding of exactly how your advisor gets paid. Some pros may offer a free consultation, but it's only fair to pay them for their services after that. When you work with a financial advisor, you're not just paying someone to manage your funds. You're paying for a full service professional, someone who can guide you to set realistic goals, help you save consistently month after month, calm your nerves when the market is down, and answer any questions you have about your investments. In my experience, the value of that relationship is worth every penny. A great financial advisor can clearly tell you not only how they're paid, but also why it's worth it. That's what you're looking for. If an advisor dodges a question about fees, take that as a sign to go elsewhere. Don't work with someone who won't give you a straightforward answer about how they're paid. Question number 6. How will you measure and evaluate my investment performance? You want a pro who sees the big picture, not just individual fund performance. A great financial advisor will evaluate your portfolio performance in light of your risk tolerance and long-term goals, as well as current trends in the stock market. Rate of return is important, but it isn't the only factor to consider. Make sure the financial advisor you choose sees the value of a diverse portfolio and regularly rebalances your funds. Please see my video on dollar cost averaging and rebalancing. That way, when some funds are down, the others can pick up the slack with above average returns. A diversified portfolio will help you grow your investment steadily over time. Interview question number 7. Can you tell me why the last 2 clients you lost stopped working with you? Things don't always work out, and it's not necessarily a red flag if an advisor you're considering has lost a couple of clients recently. Notice how an advisor answers this question and whether or not there seems to be a pattern. If a pro lost 2 clients in the past month because they were frustrated by a lack of communication, that's probably a bad sign. And last but not least, interview question number 8. How long have you been a financial advisor? This is a very simple, often overlooked question. Ask potential advisors how long they've worked at their firm. If they worked at another firm previously, ask why they moved. Also, they should have at least one, preferably more than one, crash or significant correction under their belt, such as what we've had in 2020. There was one in 2018, 2015, the 2008, and then finally 2002 dot-com crash. Finally, let's talk about robo-advisors. They come in various forms, most being companies where you take the KYC online. The portfolio is generated for you in an instant based on your goals, time horizon, and risk tolerance answers, and your money is invested. They have various compensation schemes, sometimes being free for portfolios under 20,000, and generally charging a percentage of assets as an annual fee, even though some just have a fixed annual fee of $20 to $40 a month, for example. Contrary to the name, you can usually access a real person by email or phone, but you may have to pay extra or you may need to wait a day or two. They are cheaper. Do your research and find a robo-advisor that works the best for you and charges the least for what you want to do, including no annual fees for a registered account, for example, if that's what you want to use. Secondly, robo-advisors are affordable and accessible. Most require very small account minimums and in some cases no minimums at all, meaning you can start investing with just a couple of bucks. Annual management fees can also be very low, typically ranging from 0.25% to 0.5%, and then they can change after that, or as I said, there could be a fixed fee. They use low-cost investments, usually ETFs that follow an index, so the investments are simple and diversified. And the last advantage is that robo-advisors will automatically rebalance your portfolio for you, which is a big plus. So to conclude, financial advisors are part of the investing landscape, perhaps a little less popular with the advent of robo-advisors and people running their own portfolios online or through various apps. You don't need to use a financial advisor, but if you do, make sure they add value and make a difference in your investing experience. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.